Every election promises change. Every campaign speaks the language of growth, fairness, and opportunity. New leaders come and go. Parliaments shift. Presidents rise and fall. And yet, beneath this constant noise of democracy, there exists a layer of power that rarely changes, rarely speaks, and almost never asks for permission. It does not appear on ballots. It does not make speeches. Most people could not name a single person who runs it. But it decides how expensive your mortgage becomes, whether your savings grow or shrink, and how easily governments can spend money they do not have. This power is not a conspiracy. It does not operate in secret rooms filled with shadows. It operates openly, through technical language, spreadsheets, and policy meetings that rarely make headlines. Its name sounds harmless, even boring: the central bank. To most people, central banks feel distant, abstract, something economists talk about on television when interest rates move a quarter of a point. But that distance is an illusion. Central banks sit at the very center of modern economic life. They decide how much money exists in the system. They decide when credit flows freely and when it suddenly freezes. They decide which crises get rescued and which ones are allowed to burn. When central banks lower rates, borrowing becomes cheap, markets surge, and asset prices rise. When they tighten, businesses collapse, unemployment climbs, and households feel pain almost overnight. No law needs to be passed. No vote needs to be taken. The decision is administrative, technical, and immediate. And this is what makes central banks so powerful. They are designed to stand above politics, insulated from elections and public pressure. That independence is often described as a safeguard, a way to protect money from irresponsible politicians. But independence cuts both ways. It also means decisions with enormous social consequences are made by institutions that are not directly accountable to the public. Over time, central banks have evolved from simple lenders to governments into architects of the entire financial system. They no longer just stabilize markets. They shape them. They no longer respond to crises. They anticipate them, manage them, and sometimes quietly create the conditions for the next one. This raises an uncomfortable question. If money determines power, and central banks determine money, who really governs modern societies? To answer that, we have to step backward. Long before inflation targeting, before quantitative easing, before the Federal Reserve or the European Central Bank existed at all, we have to return to a world of war, debt, and desperate governments, where the modern idea of central banking was first born. Because the story of central banks is not a story about economics. It is a story about power. The modern central bank did not emerge from economic theory. It emerged from desperation. In the 17th century, European states were locked in almost permanent conflict. Wars were expensive, unpredictable, and increasingly industrial in scale. Armies had to be paid, ships built, weapons manufactured, and supply lines maintained. Kings needed money quickly, and traditional sources were no longer enough. Taxes were slow, politically dangerous, and often resisted. Gold and silver were scarce and unreliable. Rulers turned to borrowing. But borrowing created a new problem. Governments were notoriously bad debtors. They defaulted often, changed terms arbitrarily, and seized assets when convenient. Lenders demanded higher interest or refused entirely. States found themselves trapped. They needed credit to survive, but no one trusted them. The solution was institutional. In England, this crisis reached a breaking point during the war against France in the late 17th century. King William III needed funds urgently, but private lenders were unwilling to risk another royal default. A new arrangement was proposed. Instead of lending directly to the crown, creditors would lend to a newly created institution. In exchange, that institution would receive special legal privileges, including the right to issue paper notes backed by government debt. This was the birth of the Bank of England. The innovation was subtle but revolutionary. Money in circulation was no longer limited to metal. It was now linked to the creditworthiness of the state. The bank became both the government's lender and the manager of the nation's money supply. War financing became smoother. Borrowing costs fell. Trust, once personal and fragile, was now institutionalized. Other countries took notice. Sweden had established a similar institution earlier, but it was the English model that spread across Europe. Central banks appeared wherever states needed reliable access to credit. They were not created to protect consumers or stabilize prices. They were created to make governments more powerful. By the 18th and 19th centuries, the relationship between war and central banking was unmistakable. Britain's ability to finance prolonged conflict against Napoleonic France was not based solely on military strength. It was based on its financial system. The pound sterling, supported by the Bank of England, became the backbone of global trade. Credit allowed Britain to fight longer, spend more, and outlast rivals. Wars were increasingly decided not just on battlefields, but in balance sheets. Central banks became the hidden infrastructure of empire. They enabled governments to project power beyond their immediate resources. Debt could be rolled forward. Payments could be deferred. The future could be mortgaged in the name of survival. This arrangement came with a lesson that would echo through centuries. Control the flow of credit, and you control the state. Control the state's finances, and you shape its choices, its wars, and its future. By the time the modern era arrived, central banks were no longer experiments. They were necessities. And nowhere would their power become more visible or more controversial than in the United States. When people think about power, they usually imagine presidents, parliaments, or armies. But economic power works differently. It is quieter, more structural. It operates through institutions that do not command troops, yet shape outcomes long before any political decision is made. By the 20th century, central banks had become the nerve centers of this system. To understand their power, it helps to stop thinking of them as banks in the traditional sense. They do not compete for customers. They do not exist to make profits in the usual way. They sit above the financial system, setting the conditions under which all other actors must operate. At the top of this hierarchy is the ability to create base money. Central banks alone can issue the currency that commercial banks depend on to settle payments and meet obligations. This gives them leverage over the entire banking system. When liquidity is abundant, credit expands. When it is restricted, lending contracts. Entire economies speed up or slow down based on these decisions. Below them sit commercial banks, investment firms, and financial markets. These actors appear powerful, and in many ways they are. But their freedom is conditional. They rely on central banks for access to reserves, emergency funding, and regulatory tolerance. In times of calm, this relationship is invisible. In times of crisis, it becomes unmistakable. The state occupies a unique position in this map. Governments tax, spend, and legislate. But they also borrow, and borrowing ties them directly to central banks. When governments run deficits, central banks influence how easily those deficits can be financed. Low interest rates make debt politically painless. Higher rates force difficult choices. In this way, central banks quietly discipline governments, or enable them, without ever passing a law. The United States offers the clearest example. Before the creation of the Federal Reserve, American finance was fragmented and unstable. Banks issued their own notes. Confidence was local and fragile. Financial panics were frequent. When trust collapsed, there was no central authority to act decisively. The panic of 1907 exposed this weakness. As markets seized and banks failed, it was not Congress that intervened. It was a private individual. J.P. Morgan coordinated rescues, forced banks to pool resources, and restored confidence through sheer influence. One man had done what the state could not. For policymakers, this was intolerable. Financial stability could not depend on the goodwill of a single banker. The solution was to create an institution that could act with the same authority, but with public legitimacy. The Federal Reserve, established in 1913, was designed to sit between government and markets. Independent from elections, yet deeply embedded in the financial system. This design was not accidental. Independence protected central banks from short-term political pressure, but it also aligned them closely with financial institutions that understood their language and shared their priorities. Over time, this created a powerful feedback loop. Markets reacted to central bank signals. Central banks responded to market stress. Expectations formed, hardened, and became policy constraints of their own. Globally, this model spread. The Bank of Japan, the European Central Bank, and others adopted similar frameworks. Together, they formed an informal network of monetary authorities whose decisions could ripple across borders in hours. Exchange rates moved. Capital flowed. Entire countries felt the consequences of policies decided elsewhere. This is the true map of monetary power. At the center sit central banks, controlling liquidity and credit. Around them orbit governments, markets, and institutions whose survival often depends on central bank support. Ordinary citizens, meanwhile, experience the results indirectly through prices, wages, employment, and asset values. The structure is not democratic, but it is not chaotic either. It is ordered, technical, and deeply consequential. And it raises the next question. What happens when this system is pushed beyond its limits? When crises force central banks to move from quiet managers to active architects of the economy itself? Central banks rarely announce their power in dramatic terms. They present their actions as technical adjustments, modest calibrations, necessary responses to complex conditions. Interest rates move a fraction. Liquidity facilities are expanded. Asset purchases are described in carefully neutral language. But behind this restraint lies an extraordinary level of control. At the core of central banking is a simple mechanism: the price of money. By setting short-term interest rates, central banks influence how expensive it is to borrow, save, and invest. This single variable quietly governs decisions across the entire economy. Businesses decide whether to expand or retreat. Households decide whether to buy homes or delay. Governments decide whether deficits feel manageable or dangerous. Yet interest rates are only the surface. Modern central banking operates through a network of tools designed to manage confidence. Central banks provide reserves to commercial banks, ensuring the payment system functions smoothly. They act as lenders of last resort, offering emergency funding when markets freeze. They regulate banks, shaping how much risk the system can tolerate. Each function reinforces the others. When a crisis hits, these mechanisms accelerate. In normal times, central banks influence behavior indirectly. In crises, they intervene directly. They decide which assets are acceptable as collateral. They decide which institutions receive liquidity and which do not. These choices determine survival. A solvent bank with no liquidity can fail. An insolvent institution with central bank support can endure. This power was always implicit, but the 20th century forced it into the open. World War I marked a turning point. The scale of industrial warfare shattered the old financial constraints. Taxes could not cover costs. Gold reserves were insufficient. Central banks financed governments through money creation and bond purchases. Convertibility to gold was suspended. Inflation followed. The lesson was unmistakable. In moments of existential threat, monetary restraint disappears. Central banks become instruments of state survival. The interwar period revealed the dangers of this flexibility. In Germany, political pressure pushed the central bank to print relentlessly. The result was hyperinflation that destroyed savings, social trust, and political stability. Money ceased to function as a store of value. The economy did not merely suffer, it unraveled. Elsewhere, the opposite error emerged. During the Great Depression, central banks hesitated. They allowed banks to fail, credit to contract, and deflation to deepen. The Federal Reserve's reluctance to expand the money supply turned a market crash into a global catastrophe. Millions lost jobs. Entire industries collapsed. From these failures, a new doctrine emerged. Central banks were expected to act aggressively, decisively. Better to risk inflation than allow systemic collapse. Better to create too much liquidity than too little. This mindset shaped the post-war financial order. After World War II, central banks became pillars of economic management. Through the Bretton Woods system, currencies were tied together under the dominance of the United States dollar. Monetary stability was no longer national, it was global. The Federal Reserve's policies reverberated worldwide, but this stability depended on discipline. When the United States expanded spending to fund war and social programs, the system strained. Foreign governments accumulated dollars and demanded gold. In 1971, the constraint broke. The dollar was severed from gold. Fiat money became universal. From that moment, central banks gained unprecedented freedom. Money was no longer limited by physical reserves. It was constrained only by credibility. As long as people trusted the currency, central banks could create more of it. This transformed monetary policy from management to engineering. The full implications became clear in the late 20th and early 21st centuries. When inflation surged in the 1980s, the Federal Reserve raised rates sharply. The economy entered recession. Unemployment rose. But inflation fell. The message was clear. Central banks could impose pain to restore trust. When financial markets collapsed in 2008, the response was different. Rates fell to zero. Central banks purchased government bonds, mortgage securities, and financial assets at massive scale. Quantitative easing became the new tool of stabilization. Trillions were created to prevent collapse. These interventions did not merely stabilize markets. They reshaped them. Asset prices soared. Inequality widened. Risk-taking increased under the assumption of future rescues. The pandemic accelerated this dynamic. Central bank balance sheets expanded to levels once considered unthinkable. Each intervention deepened dependence. Markets learned to listen not to earnings or productivity, but to central bank signals. Governments learned to assume cheap financing. The line between monetary policy and fiscal support blurred. Central banks had not just become managers of money. They had become managers of expectations, risk, and survival itself. And that raises a critical question. What happens when a system built on constant intervention begins to generate its own fragility? Every system built to prevent collapse eventually creates a new kind of vulnerability. Central banking is no exception. For decades, monetary authorities have acted under a simple assumption. When markets falter, intervention restores stability. When growth slows, liquidity revives confidence. When risk materializes, central banks step in as the ultimate backstop. Each crisis reinforces the belief that decisive monetary action can always prevent disaster. But this belief carries a cost. The more central banks intervene, the more economic actors adapt their behavior around that expectation. Banks extend risk, knowing liquidity will appear in emergencies. Governments expand deficits, assuming borrowing costs will remain manageable. Investors chase higher returns, confident that severe losses will be softened by future rescues. This is not a moral failure. It is a rational response to incentives. Over time, however, these incentives distort the system. Risk accumulates quietly. Debt levels rise across households, corporations, and states. Asset prices drift further from underlying productivity. The system looks stable, not because it is healthy, but because it is constantly supported. This is where the contradiction emerges. Central banks are tasked with maintaining stability. But stability achieved through perpetual intervention breeds fragility. Each rescue makes the next crisis larger. Each suppression of volatility encourages greater leverage. The very tools designed to smooth economic cycles begin to amplify them. Inflation exposes this tension most clearly. For years after the global financial crisis, central banks expanded balance sheets without triggering consumer price inflation. This reinforced confidence in their control. But the absence of inflation was not proof of safety. It reflected structural forces, globalization, technological efficiency, weakened labor power. These forces suppressed prices while asset inflation surged quietly in the background. When those forces shifted, the system's limits became visible. Pandemic disruptions fractured supply chains. Energy shocks reverberated globally. Labor markets tightened. Suddenly, money creation collided with real-world constraints. Inflation returned not as a theoretical risk, but as lived experience. Prices rose faster than wages. Savings lost value. Political pressure intensified. Central banks faced an impossible choice: continue supporting growth and risk runaway inflation, or tighten policy and trigger recession, financial stress, and political backlash. There was no neutral option. Every path redistributed pain. Raising interest rates exposed another fault line. Years of cheap money had reshaped the financial architecture. Governments carried enormous debt loads. Corporations depended on refinancing. Asset prices were built on low discount rates. When rates rose, pressure spread rapidly through the system. Bond markets wobbled. Banks holding long-term assets faced losses. Emerging economies felt capital flight. Housing markets slowed. What had seemed manageable under intervention became unstable under restraint. This is the strategic breaking point. Central banks cannot normalize policy without destabilizing the structures that grew under their protection. Yet, they cannot maintain permanent intervention without eroding the credibility of money itself. Inflation undermines trust. Deflation destroys activity. Both threaten legitimacy. History offers no painless solution. Past monetary systems collapsed not because central banks failed to act, but because they acted too long in ways that postponed reckoning. The gold standard constrained excess until it broke. Bretton Woods stabilized currencies until imbalances became intolerable. Each system appeared durable, until it suddenly was not. The modern fiat regime is more flexible than any before it. But flexibility is not immunity. It trades hard limits for soft ones. Trust replaces metal. Credibility replaces convertibility. Once that trust erodes, central banks have no tool powerful enough to restore it quickly. This is why confidence matters more than models. If households believe inflation will persist, behavior changes. Spending accelerates. Wage demands rise. If investors doubt fiscal discipline, risk premiums increase. If governments assume central banks will always intervene, discipline dissolves. Expectations become self-fulfilling. Central banks attempt to manage this through communication. Forward guidance. Carefully calibrated language. But words cannot substitute for structural reality forever. When policy promises conflict with lived experience, credibility weakens. This does not mean collapse is inevitable. But it does mean that the current system rests on a narrow margin of error. One misjudged tightening. One political intervention. One loss of confidence at scale. The paradox is clear. Central banks became powerful by solving problems created by debt, war, and instability. Now they preside over a world where their solutions have become part of the problem. They cannot retreat without consequence. They cannot advance without risk. The system no longer asks whether central banks should intervene. It asks how long intervention can continue before the costs outweigh the stability it provides. And when that balance finally tips, the consequences will not remain confined to policy meetings or financial markets. They will spread outward. When central bank policy changes, it rarely feels dramatic at first. There are no sirens, no public announcements of emergency. A rate decision is released. A press conference follows. Markets react quietly, then violently. And only later does the real impact reach ordinary lives. This delay creates the illusion that monetary policy is abstract. In reality, it is one of the most direct forces shaping daily economic experience. Interest rates determine the cost of shelter. When central banks keep rates low, mortgages become affordable, housing demand surges, and prices rise. Homeowners feel wealthier. Renters fall further behind. When rates rise, the process reverses. Monthly payments jump. Transactions freeze. Construction slows. The same tool that once stimulated growth now inflicts pressure, often on the same households it previously encouraged to borrow. Savings tell a similar story. Low rates punish savers quietly. Bank deposits yield little. Pension funds struggle to meet obligations. Retirees are pushed toward riskier assets in search of return. This shift is not the result of personal choice alone. It is a response to an environment engineered by central banks. When money is cheap, caution becomes costly. Asset ownership becomes the dividing line. Those who hold stocks, real estate, or financial assets benefit disproportionately from monetary expansion. Asset prices rise faster than wages. Wealth concentrates. Those without assets experience inflation as erosion, not enrichment. The gap widens, not because of effort or merit, but because of access to the financial system. Employment is shaped by these same forces. Easy credit allows companies to expand, hire, and invest. Tight credit forces layoffs, cost-cutting, and retrenchment. Central banks do not set wages, but they influence labor markets by controlling demand. When they prioritize inflation control, unemployment becomes the adjustment mechanism. This trade-off is rarely stated plainly, but it is implicit in every tightening cycle. Governments feel the effects as well. Low interest rates reduce the cost of public borrowing. Deficits appear manageable. Political pressure to reform spending diminishes. When rates rise, fiscal reality returns abruptly. Budgets tighten. Taxes rise or services are cut. Central bank decisions expose choices that were deferred, not avoided. Globally, the spillovers are even more severe. When major central banks tighten policy, capital flows toward higher yields. Emerging markets face currency depreciation, higher borrowing costs, and financial instability. Decisions made in Washington, Frankfurt, or Tokyo reshape conditions thousands of miles away. Sovereign debt crises are often triggered not by domestic mismanagement alone, but by shifts in global liquidity. This creates a hierarchy of monetary power. Countries that issue reserve currencies enjoy flexibility. They can borrow in their own currency. They can rely on global demand for their assets. Others must earn credibility, often through austerity and discipline imposed externally. Central banks reinforce this hierarchy by determining which currencies anchor the system and which absorb its shocks. During crises, these dynamics intensify. In 2008, central banks rescued financial institutions deemed systemically important. Jobs were lost, but banks survived. During the pandemic, massive liquidity supported markets, while supply constraints drove inflation. The perception hardened that monetary policy protects capital more reliably than labor. Whether this is intentional matters less than the outcome. Central banks operate under mandates: price stability, employment, financial stability. But these goals conflict in practice. Choices must be made. Trade-offs are unavoidable. Each intervention redistributes risk and reward across society. This is why central bank power generates political tension. Citizens vote for governments, but experience the consequences of monetary policy. When inflation rises, blame falls on elected officials. When unemployment spikes, political backlash follows. Yet, the levers controlling these outcomes often lie elsewhere. This disconnect fuels frustration, populism, and distrust. Transparency does not fully resolve the problem. Central banks publish minutes, forecasts, and models. But complexity shields accountability. Few voters can trace a policy decision to its downstream effects. Fewer still can influence it. The result is a sense of powerlessness in the face of economic forces that feel imposed rather than chosen. And yet, central banks persist because alternatives are worse. A world without them would be more volatile, not more just. The challenge is not their existence, but their dominance. When monetary policy becomes the primary tool for managing structural problems, it stretches beyond its capacity. Inequality, productivity, supply constraints, and fiscal imbalances cannot be solved by interest rates alone. The spillover effects reveal the truth. Central banks do not just manage money, they shape opportunity, security, and risk across entire societies. Their influence is felt in homes, workplaces, and governments long after policy meetings end. Which brings us to the final question. If central banks hold this much power, and if their tools carry such consequences, what does that mean for individuals navigating a system they do not control? Central banks do not rule in the way governments do. They issue no slogans, command no police, and campaign for no votes. Yet their influence runs deeper than legislation, because it operates at the level of money itself. In the modern world, money is not just a medium of exchange. It is a claim on future resources, enforced by trust. Central banks manage that trust. When they expand the money supply, they redistribute purchasing power. When they tighten, they decide whose plans survive and whose fail. These outcomes are not accidental. They are the consequence of institutional design. This does not mean central bankers are villains or masterminds. They are responding to incentives, constraints, and crises inherited from decades of political choices. But intention does not negate impact. The power to create money is the power to shape society. Understanding this changes perspective. Economic outcomes are not simply the result of markets or elections. They are mediated by institutions that sit between the two. Central banks translate political pressure into monetary action and market stress into policy response. In doing so, they become the quiet governors of modern economies. For individuals, this reality carries a lesson. Stability is conditional. Inflation and deflation are not accidents. They are tools with distributional consequences. Wealth stored only in nominal claims is vulnerable. Resilience lies in diversification, productivity, and assets that retain value independent of monetary expansion. Skills, real assets, and adaptability matter more than promises of stability. History does not suggest an imminent collapse, but it does warn against complacency. Every monetary system appears permanent until its assumptions fail. Gold standards break. Pegs dissolve. Credibility erodes gradually, then suddenly. Central banks will continue to manage crises. They will continue to intervene, but they cannot eliminate trade-offs, only postpone them. The real question is not whether central banks control money. They do. The question is whether societies understand the power they have delegated and whether they are prepared for the consequences when that power reaches its limits. If this reframed how you see money, stay with the channel. The future of finance is never written in isolation. It is written in the systems we build, the trust we extend, and the choices we fail to question.